What if I told you that 95% of investors, yes, even the so-called Wall Street professionals, end up losing to the market? Imagine this, a young trader in a flashy suit, glued to 10 computer screens, analyzing charts, placing rapid trades, convinced he's about to outsmart everyone. Now picture an ordinary teacher who quietly puts $200 a month into a boring index fund, and 30 years later, she retires wealthier than the trader ever dreamed. This isn't a fantasy. It's the hidden truth Jack Bogle revealed to the world. He was the founder of Vanguard and the man who gave us the index fund. A tool so powerful that it flips Wall Street's game on its head. Here's the shocking part. The secret to building wealth isn't about being smarter, faster, or luckier than the next investor. It's about understanding one simple rule that beats 95% of them consistently, predictably, and almost effortlessly. And in this video, we're going to break down exactly what that rule is, why it works, and how you can use it to grow your own wealth, no matter where you're starting from. So buckle up, because once you see how simple this really is, you'll never look at reinvesting the same way. Here's the harsh reality. Wall Street doesn't want you to know this secret, because the moment you do, their billion-dollar machine of expert stock picking, high-fee funds, and flashy predictions begins to crumble. Think about it every year. Armies of analysts, hedge funds, and financial gurus promise to beat the market. But study after study shows the same result: the majority fail. Not just amateurs, not just some of the time. Even the professionals, with all their resources, consistently underperform once you factor in fees, taxes, and trading mistakes. And yet, millions of people still hand over their hard-earned money, chasing hot tips, the next Amazon, or some magic formula. Why? Because we're wired to believe that wealth comes from finding an edge, something others don't see. Fear and greed trick us into thinking we can outsmart the system. But Jack Bogle proved the opposite. He showed that the smartest investors aren't the ones chasing trends. They're the ones who stop playing Wall Street's rigged game altogether. And here's where it gets exciting, because in a moment, I'll reveal the 5 simple rules Bogle taught that can help anyone, even with zero investing experience, grow wealth more reliably than the majority of professionals. So if you've ever wondered how to finally take control of your money without getting burned by the hype, stay with me. And while you're here, hit subscribe for more powerful breakdowns like this every week, so you never miss a strategy that could change your financial future. Rule number 1, you can't beat the market. Here's the truth that shatters egos on Wall Street. You cannot beat the market, of course. Some investors get lucky. They'll brag about picking Tesla before it exploded, or selling just before a crash. But here's what the data says: over the long term, 95% of professional money managers, people whose full-time job is investing, fail to outperform the overall market index. Why? Because the market already reflects the collective knowledge of millions of investors. Every scrap of information, earnings, news headlines, and interest rates is instantly priced in. By the time you or I think we found an opportunity, thousands of others have already acted on it. Think of it this way: beating the market consistently is like flipping a coin 100 times and expecting heads to land 70 times. You might get lucky on a few flips in a row, but eventually the law of averages wins. Bogle called this the loser's game. The more you try to outsmart the market, the more you lose to trading fees, to taxes, and most of all, to bad decisions driven by emotion. So what's the smarter move? Stop trying to beat the market, and instead be the market, own it, capture its average return, because that average ends up being better than almost everyone else's best effort. And that brings us to Bogle's next timeless lesson, the powerful tool that makes this possible, and why it's been quietly creating millionaires for decades. Rule number 2, the power of index funds. When Jack Bogle launched the first index fund in 1976, critics laughed at him. They called it Bogle's folly, saying no one would ever invest in something designed to just match the market instead of beating it. But here's the twist. What they mocked ended up becoming one of the most powerful wealth-building tools ever created. An index fund is simple. Instead of trying to pick the right stocks, it buys a tiny piece of every company in a market index, like the S&P 500. That means when Apple wins, you win. When Amazon wins, you win. And when a company crashes, It barely matters because the other 499 companies keep carrying you forward. The beauty of index funds is in their simplicity and cost. No expensive fund manager, no endless trading, no gambling on hunches, just automatic ownership of the market's long-term growth. And guess what? That boring approach quietly outperforms the majority of flashy, high-cost funds. Why? Because while others are burning money on fees, commissions, and bad bets, the index fund just keeps compounding steadily, year after year. This is why Warren Buffett, himself one of the greatest investors of all time, advises most people to put their money into low-cost index funds. In fact, he once bet $1 million that an index fund would beat a group of hedge funds over 10 years. The result? The hedge funds got crushed. Bogle's message is clear. Stop chasing unicorns and instead own the whole herd. But even when people understand this, there's one hidden enemy that keeps draining their wealth without them noticing. And that's where we get to the third rule. Rule number 3. Fees are silent killers. Imagine this, you invest $10,000 today. Over 40 years, the stock market has given you an average annual return of about 7%. Without touching it, that money grows to nearly $150,000. Now add just a 1% annual fee, the kind most mutual funds quietly charge. Suddenly, your $150,000 shrinks to around $100,000. That's $50,000 gone. Not because the market failed you, but because of fees. Jack Bogle called this the tyranny of compounding costs. Everyone loves talking about the magic of compound interest, but almost no one realizes the same compounding works against you when you're paying even small fees year after year. And it's not just fees, it's trading costs, fund expenses, and even taxes from too much buying and selling. Wall Street thrives because millions of investors never notice this slow leak. Think about it like this. You're filling a bucket with water, your savings, but there's a tiny hole at the bottom. Day after day, drip by drip, your future wealth leaks out. Over the decades, that tiny hole has become an ocean. Bogle's solution? Keep costs as close to zero as possible. That's why he designed Vanguard index funds with ultra-low fees, sometimes as low as 0.03% compared to a 1% mutual fund fee. That difference alone could mean hundreds of thousands of extra dollars in your pocket over a lifetime. So if you take nothing else from Bogle's wisdom, remember this. It's not just about what you earn, it's about what you keep. But even if you cut fees to the bone, many investors still make one fatal mistake trying to time the market. That's where rule number 4 comes in. Rule number 4. Time in the market beats timing the market. Here's a sobering truth. Most people lose money not because the market fails them, but because they fail themselves. They buy when stocks are soaring, chasing the hype. Then they panic sell when prices crash, locking in losses. It's an emotional roller coaster, and Wall Street profits every time. Jack Bogle warned against this trap. He said, don't do something, just stand there. His point, patience beats prediction. If you invested $10,000 in the S&P 500 in 1990 and simply held on by 2020, you'd have over $170,000 even after surviving dot-com crashes, the 2008 financial crisis, and countless downturns. But if you missed just the 25 best days in those 30 years, your return would have been cut in half. Half your wealth is gone because you thought you could outsmart the timing. The lesson? Markets always rise over time. Yes, there will be crashes, sometimes brutal ones, but every single downturn in history has eventually been followed by recovery and growth. The winners are the ones who stay invested. They ride out the storms, keep adding to their snowball, and let compounding do the heavy lifting. So forget the headlines screaming about the next crash or the perfect entry point. The perfect time to invest is not yesterday, not tomorrow, it's as soon as possible, and for as long as possible. And that brings us to Bogle's final and most important rule, the one that determines whether you actually succeed with everything we've discussed so far. Rule number 5, discipline wins. Jack Bogle knew that the hardest part of investing isn't math, it's psychology, because when the market crashes 30%, your brain screams, get out before it's all gone. And when it's up 30%, your brain whispers, put in more, you're missing out. These emotional impulses, fear and greed, are what destroy portfolios. Investors abandon their plans in moments of panic or euphoria, and they pay the price. Bogle's advice was brutally simple: create a plan, then stick to it no matter what. Whether that means investing a fixed amount every month, reinvesting dividends, or rebalancing once a year, the key is consistency. Think of investing like planting a tree. You don't dig it up every few months to check the roots. You water it, protect it, and let time do the work. The people who get rich are not the ones who knew when the storm was coming. They're the ones who stayed calm and kept planting even in the rain. And here's the kicker: if you can master your emotions, you already have an edge over most investors. Not because you're smarter, but because you're steadier. Discipline is the invisible superpower of wealth. It's the difference between a portfolio that grows for decades and one that crumbles the moment life gets turbulent. So yes, Jack Bogle gave us the tools, but only you can decide whether you'll use them with the patience and discipline they demand. So let's recap Jack Bogle's timeless rules. You can't beat the market. Stop trying to outsmart it. Own it. Use index funds. Simple, low cost, and proven to outperform the majority of active managers. Cut the fees. Even 1% can quietly steal hundreds of thousands from your future wealth. Stay invested. Time in the market always beats trying to time the market. Have discipline. Create your plan, stick with it, and let compounding do the work. This is the simple investment trick Wall Street never wanted you to know because it makes their expensive advice irrelevant. Here's the truth: wealth isn't built by chasing hot stocks or trusting gurus. It's built by playing the long game, protecting yourself from hidden costs, and letting your snowball roll year after year. So here's my challenge for you. What's one small step you can take today to start building your own wealth? Snowball, is it opening your first index fund, automating your investments, or simply committing to stay the course when the market gets rough? Drop your answer in the comments. I'd love to see how you'll put Bogle's wisdom into action. And if you found this video valuable, make sure you hit subscribe for more financial wisdom every week. Share this with someone who's still chasing stock tips. They need to hear this. Finally, I highly recommend The Psychology of Money by Morgan Housel. It's the perfect companion to Bogle's rules because it doesn't just teach you how to invest, it shows you how to master the emotions that make or break every financial decision. Remember, wealth isn't about genius or luck. It's about patience, discipline, and common sense. Start rolling your snowball today and watch what it becomes in the years ahead.